Okay, welcome back to my YouTube channel. So today I'll take you through question 23. This was April 2023 CT. And it reads, the following draft financial statements relate to H Limited and its investment companies, S Limited and A Limited for the year ended 31st December 2022. Yeah, so we have all that. Then we have the addition of information. The following details relate to the acquisition. Then H Limited also invested in shillings 25 million of the loan stock in S Limited on 1st January 2021. Then on the dates of the acquisition, the value of building in S Limited and A Limited was shillings 50 million and shillings 25 million above their carrying amounts. That's the fair value uplift. Buildings are depreciated at the rate of 2% per annum on reducing balance. The fair value of the non-controlling interest in bracket purchase consideration can be estimated from the share price of S Limited, that was shillings 80 on 1st January 2019. So here we'll change to shillings 8. Yeah, this was an error. Then we go to number 2. On 1st January 2021, H Limited sold S Limited an item of plant at selling price of shillings 75 million, reporting a profit markup of 50%. Plant is depreciated at 20% per annum on reducing balance. Number 3, during the year, the company is treated as follows. 1. S Limited sold goods at a selling price of shillings 20 million to H Limited at the normal gross profit margin. 1/4 of these goods remain unsold at the year end. 2. H Limited sold goods at a selling price of shillings 40 million to A Limited, reporting a profit of shillings 10 million. Half of the goods sold to A Limited has been sold by the year end. Then at the beginning of the year, H Limited had goods to the value of shillings 10 million purchased from S Limited in the year ended 31st December 2021. Included in the trade receivables and payables of each of the respective companies are the following intercompany balances. You have due from H Limited to S Limited, due from A Limited to H Limited. A close check in S Limited's books revealed that the receivables of S Limited had shillings 30 million due from H Limited. These anomaly arose because H Limited sent a check for shillings 5 million to S Limited on 29th December 2022, but had not been received by S Limited as 31st December 2020. So the 5 million is the cash in transit. Meanwhile, all the companies had paid their interest on loan stock by the year end. Number 5, goodwill where relevant had been impaired by 20% on cost at the beginning of year 2022. An additional impairment of 20% of the initial cost was again reported in year 2022. So that's the impairment. So we required to prepare the consolidated statement of financial position as of 31st December 2022. So this is how we are supposed to do this question. So I'll start my solutions here. So I'll write solutions. And first I am supposed to identify my investee companies. So S is a subsidiary. S is a subsidiary because we have 80. H has 80%. Yeah, control. Yeah, while A we have 30%. So it's an associate. A is 30%. It's an associate. Yeah, so when we are consolidating, we only consolidate between the parent, which is the holding company, and the subsidiary. So we'll only consolidate between H and S. The first thing I'll do, I'll calculate the goodwill. We'll calculate the goodwill on acquisition of these two investee companies. So let's say goodwill, then I'll say for S, then for A. So I'll start with the S. So the first thing for goodwill, we'll use for S, we'll use the full goodwill method. So I just say purchase consideration. Purchase consideration. Purchase consideration. Let me just enlarge this. So the purchase consideration for S, just come here, what was invested? Yeah, it was acquired on 1st January and the cost of investment was this. So I just select it. Yeah, then there's fair value of NCI. Fair value of NCI. Yeah, Yeah, so the fair value of NCI, there's a statement on the additional information. They're saying the fair value of the non-controlling interest in bracket purchase consideration can be estimated from the share price of S Limited. That was shillings 8. I said that to change this 18 to 8 on 1st January 2019. So this is how we will calculate it. You'll say, you'll look at the number of shares. So under this statement of financial position, we have this, the value for shares is this. So I'll select it and divide by the par value. The par value we are told it's 5. Then the fair value of NCI is 20%. 20%. Yeah, but they were trading at 8% in 2019 when it was acquired. So I'll multiply by 8 and I'll get the 160,000. So I'll sum this. I'll sum this here. This 2. And I'll have 9, 10. Then I'll less the net assets acquired. So the net assets will start with the ordinary shares. Ordinary. So just write ordinary. So the interest of time. So ordinary shares. Love this. I'll just say equals to. I'll pick. You pick this for the subsidiary. Then the next one is the retained profit. And the retained profit, we use the one at acquisition, the pre-acquisition one, the one which was available when we acquired the pre-acquisition. So the pre-acquisition under S is this, the retained profit is this. So I'll pick that. Then there was a statement. There's a statement which talk of the fair value uplift. Some people called it revaluation. So they're saying on the date of the acquisition, the value of buildings in S Limited and A Limited was shillings 50 million and shillings 25 million above their carrying amount. So the fair value uplift under S is 50 million. So I just come here and say fair value uplift. Yeah, and it's 50 million. So it's 50,000 because I'm using my values into thousands. Yeah, so there's no any other net assets which was acquired. Yeah, so there are only those 3. So I'll calculate the goodwill before impairment. Yeah, so it's also called goodwill and impaired. So goodwill here will be equals to, we pick this minus the sum of this and the sum of that. Yeah, so the goodwill will be that. So we'll go and look for the impairment loss. Impairment loss. Yeah, so the impairment loss, this is how we are calculating it. So we are told on additional information, the last one here, goodwill where relevant had been impaired by 20% on cost at the beginning of year 2022. An additional impairment of 20% of the initial cost was again reported in year 2022. So it means at the beginning of this year, there was an impairment of 20% and there was another 20%. So I'll just pick the total, which is 40%. Yeah, because they're all on cost. So I'll just pick and multiply by this and I'll get the impairment as 64. Yeah, so my goodwill and impaired, which will go to the statement of financial position, will be the difference between these two. I'll just say equals to this minus this, and I'll get 96,000. Yeah, so that's how you're supposed to do that goodwill. So I'll go to A. I'll also pick the purchase consideration, which is here. It was 300,000. Then the fair value, there was no fair value. So we'll use the partial goodwill method. So I'll start with ordinary. So I'll pick the ordinary. Yeah, but now under A. So I'll pick this, enter. Then I go to return profit. I'll pick the one at acquisition. This one. Then I'll have the fair value uplift. We were told that the value of the building was 25 million above their carrying amounts at acquisition. So it's 25 million. So I just write 25,000. Yeah, so 25,000. So this is what I will do. I'll sum this, then I apportion because it's partial. So I'll sum the net assets. Then I'll say bracket, then I'll just multiply by 30% because we are only controlling 30%. So I'll get to 17. So my goodwill here will be purchase consideration minus net assets acquired. Yeah, and I'll have 82,500. Then the impairment loss will be still be 40% times the goodwill. Yeah, so my net goodwill will be the difference. So I'll just drag, I'll just sit here, just come here and drag and see if it will copy. Yeah, so my goodwill here will be 49,500. Yeah, so I've used this information to calculate goodwill. So I'll go to the second part. On the dates of the acquisition, the value of building S Limited are 50 and 25 million above the occurring amounts. We have used that as the fair value uplift. Buildings are depreciated at the rate of 2% per annum. So we are going to look at the depreciation of the fair value uplift. So I'll say depreciation. And I'll say S. Yeah, let me say depreciation S here, then depreciation A. Yeah. So we are told that the depreciation was at the rate of 2% per annum on reducing balance. So we look at the time when S first was acquired. So the amount was, the total amount for S was, how much was 50. So let me just delete this. And say S is 50,000. Then A is 25,000. A was 25,000. So I'll come to depreciation. And I'll say depreciation. So depreciation both, and also depreciation under A. So I'll start with S. S was acquired in 2019, on 1st January 2019, and we are on December 2022. So it has been there for 4 years. So this is what I'll do. I'll say 2019, 2020. I'll calculate the depreciation every year so that you see, yeah, on a reducing balance. Yeah, so I'll start with 2019. Yeah, so I'll pick this and I'll multiply. The depreciation was 2%. So I'll just pick times 0.02 and I enter. So for the second year, which is 2020, I'll pick the 50,000. But I'll subtract this because it's on a reducing balance. Then I multiply by the 0.02. Yeah, then I'll come to the third year. I'll pick this. Then I subtract this and this. Yeah, because it's on a reducing balance, then I'll multiply this by 0.02. Yeah, then the last one, I'll pick the initial cost, then I subtract this, I subtract this, and I also subtract this. Yeah, on a reducing balance. Then I multiply the whole amount, 0.02. Yeah, so that I can sum the total depreciation, yeah, for the 4 years. So I'll have 38, 81.6. So I'll come to depreciation under A for building A. So I'll do the same. But for A, we look at when it was acquired. It was acquired in January 2020. So it means that it has been in existence for 2020, 2021, and 2022. So I'll start at 2020. I'll pick this. Then I multiply by the rate, which is 0.02. Then for the second year, it's on a reducing balance. So I'll pick this 25. Then I'll minus 500. Then I'll multiply by 0.02. And then for the last one, I will do the same. I'll pick 25. Then I'll subtract this. I'll also subtract this. Then I'll multiply this by 0.02. Yeah, then I'll sum. So I can just drag this for the interest of time. Yeah, so it'll give me 1470.2. Yeah, so I've done the depreciation. So this is what we call the cumulative depreciation under each category, under the fair value. Yeah, so I'll have to depreciate, and I had to depreciate that. So I'll go to The next statement, the fair value of the non-controlling interest purchase consideration can be estimated from the share price of S Limited. That was shillings 80 and first, and we say we change this to 8 and we have used it. So I go to number 2. On 1st January 2021, H Limited sold S Limited an item of land at a selling price of 75 million. Up to there, those are intergroup sales, reporting a profit markup of 50%, full stop. Plant is depreciated at 20% per annum on reducing balance. On this statement, what we are supposed to calculate is, first I'll say it was a downstream sale. So it was H to S. And the first thing we have to calculate here is the UPFA. UPFA. Yeah. So the UPFA here we'll say equals to, it's always the profit margin times the selling price of the plant or property. So we have been given markup as 50%. So when we are given markup as 50%, then it means that the margin will be 50. The market price 50 over 100. So the margin will be 50 over 150. So you take the 50, you add to 100. So then you multiply by 75 million. So it's 75,000. Yeah. So you get the UPFA as 25,000. Then we are told that plant is depreciated at 20% per annum on reducing balance. So this is what we call excess depreciation. Yeah. So excess depreciation. Yeah. So the excess depreciation, you calculate it based on the UPFA. UPFA is the unrealized profit on fixed assets. So this is what you do. You just come here and say, you check. We are told that the item was sold in 2021 January. So it means that we have to depreciate the UPFA in 2021 and 2022. So this is what I'll do. Just write 2021, then 2022. So for 2021, I'll pick, it was the 20%. So 20%, but remember it was on a reducing balance. So I'll multiply. The excess depreciation is on UPFA, the cost, not the selling price of the item. So I'll do that. Then for the second year, it will now be this minus this. Then I multiply by the depreciation rate, which is 20%. Yeah, so my total depreciation will be the sum of these two. Enter. So I'll get 9,000 excess depreciation. Yeah, so I'll go to additional information number 3. They're saying during the year, the company traded as follows. S Limited sold goods at a selling price of shillings 20 million to H Limited at the normal gross profit margin. 1/4 of these goods remain unsold at the year end. So first we look at the sale. Is it downstream or upstream? So it's S to H. Yeah, S to H is an upstream. So this is what we'll do. So we'll calculate what we call unrealized profit on inventory, UPI. So I just come here and say equals to, we are told that the normal profit margin. So this I'll pick, it's 50 over 150. That's the normal margin. Then I'll multiply by 20 million, which is in this case will be 20,000 times. Now we are told that the items which remained unsold were quarter, so times 1/4. Yeah, so my UPI will be 1666.7. And that will be my UPI, unrealized profit on inventory. Yeah, so I'll go to number 2. We are told that H Limited sold goods at a selling price of shillings 40 million to A Limited. So I just say H to A, H to A. And this also is unrealized profit. Yeah. Though it's to an associate. So I'll just come and say UPI. And they're saying that they sold 40 million to A, reporting a profit of 10 million. Half of the goods sold to A Limited had been sold by the year end. So this, what I'll do, I just take the 10 million, which is 10,000 here, and I multiply by half. And I'll get 5,000 as my UPI. Yeah, then I'll go to, at the beginning of the year, H Limited had goods to the value of 10 million purchased from S Limited the year ended 31st. So this information is unnecessary. We won't use it for consolidation. So I'll go to additional information number 4. They are saying included in the trade receivables and payable of each of the respective companies are the following intercompany balances. So at intercompany balances, we only consider the balances between the parent and the subsidiary. So I'll only use this when we are consolidating, and I'll have to subtract it from trade receivables and trade payable. Then they're saying a close check in S Limited's books revealed that the receivables of S Limited at shillings 30 million due from H Limited. They normally arose because H Limited sent a check of shillings 5 million to S Limited on 29th December 2022, but had not been received by S Limited as of 31st December. So that's what we call the cash in transit. Yeah, that's what we call the cash in transit. So let's say cash in transit. Yeah, so cash in transit, it was 5 million, so it's 5,000. Yeah. And they say, meanwhile, all the companies paid their interest on loan stock by the end, so there's no interest to be paid. Then goodwill, where relevant, we have already used that. So with that, I've done the analysis. So I'll do 3 more. So I'll do the investment, yeah, in associate, which is here in this case, I'll do calculation for investment in A. So I'll just say investment in A, which is an associate. So when you are doing investment in associate, you start with the initial investment. Sorry. Initial investment. So the initial investment, in this case, let me just drag this so that it can be clear. So the initial investment in this case will be the cost of investment under A. So it is here. So I'll pick this. Then I'll add post-acquisition profit or reserves. So post-acquisition profit. So the post-acquisition, this is how you do it. Just come here and say equals to, then you put the bracket. Then you look at the retained profit under associate at the close of the year. So just come here and pick this. Then you subtract the pre-acquisition retained profit. So subtract this. Then you put the bracket. And because it's an associate, we only take our portion, which is 30%. Yeah, we only take our portion, which is 30%. Yeah, so in this, we'll now deduct the expenses. So the first expense that we'll deduct is the depreciation on building. So there was a depreciation on that fair value uplift. So depreciation on building. Yeah. Yeah, so I just come here and say equals to. I'll go there and look at the depreciation. Look at the depreciation. Yeah, it was this. But remember, this was for the all. But our portion is only 30%. 30%. And because it's an expense, I want to deduct it and just put a negative sign here so that when I enter, it changes automatically. So the next one will be the impairment loss. Yeah, the other deduction is the impairment loss. So for the impairment loss, just go here and pick this. I'll pick it only because already we have apportioned it. Yeah, this was 33, but this was our 30%. So I'll also put it a negative sign before it. Yeah, so the other adjustment will be we have the UPI. You can see H sold to A. So the UPI also will pick it in full. We'll pick it in full. Yeah. We'll pick it in full because it was a downstream. So I just say equals, then I'll introduce a negative sign. Then I'll pick this and enter. Yeah, so that I sum all this. There's no any other adjustment and investment in associate. Then I'll just drag this and enter. So I'll have 312 558.9. So I'll go to another adjustment, which is NCI equity. So I'll go to the NCI equity. NCI equity. Yeah, so I'll start with the fair value of NCI. Fair value of NCI. So under the fair value of NCI, just pick the fair value because NCI is part of the subsidiary. Yeah, so I'll just go to the fair value of NCI, which is here. I'll pick it and I'll add post-acquisition profit. Post-acquisition profit. So my post-acquisition profit, this is how I will do it. I'll go to the retained earnings under subsidiary now, retained profit, and I'll pick this at the year end. Then I'll subtract with the retained earning at the beginning of at acquisition, yeah, the pre-acquisition. Then I'll multiply by the portion. Our NCI portion is 20% because we took 80%. So I'll take 20% and enter. Yeah. So I'll add that. Then I'll subtract the impairment loss. Subtract the impairment loss. Yeah, so I'll come here and say equals to. I'll go to the impairment loss. I'll start with the negative sign because I want it to be negative. So I'll come to impairment loss. For subsidiary, it was 64,000. So I'll take the 64,000. Then I portion. I'm supposed to take only 20%. Yeah, because that's our share of NCI. Yeah, so the next item, I'll go to depreciation of the fair value uplift. This one. So I'll go to depreciation. Of, let me say, building. But this building is the subsidiary under S. Yeah, so I'll go and say equals to, and also a portion. So I'll pick this because this is the depreciation under S, but I'll only pick 20% because NCI is 20%. And I'll put a negative sign here because it's a deduction. So I want to deduct it. And I get that value. Yeah, then I'll go to, I'll check all through. Now I'll come here and check H2S, UPFA. No. Excess depreciation, no, because it was coming from H. It was a downstream. S to H, yeah, there's where the subsidiary sold to holding company. So we'll have UPI, which is this. So I'll also apportion this UPI under NCI. So I'll apportion. Yeah, so I'll pick and say equals to, then I start with the negative, then I pick that, then I multiply by 20%. Yeah, we agreed that NCI is 20%. Yeah, then this is now H2A, which is not part of that. So, and yeah, I think all those are the all adjustments under NCI equity. So I just come here and say equals to sum. So we'll have 790. So the last adjustment which I will do is the retained earnings, also known as the retained profit. So just write retained earnings. Yeah, so under retained earnings, I'll start with the holding company. So I'll just say H. Yeah, so here I'll pick the retained earnings for H. So I just say equals to retained profit and pick this. Yeah, then I will add the post-acquisition profit now for S. So S will be post-acquisition. Sorry. Post-acquisition profit. But now this for S, which is a subsidiary. So the post-acquisition, this is how we will do it. It's equals to bracket. I'll go for the retained profit. This one for S. Then I'll subtract the one for pre-acquisition. which is this. Then I'll put the bracket, we multiply this by 80% because the holding company only control 80%. You see the 20% went with the NCI upper June. Yeah, so the next one will be post acquisition. Now on post acquisition profit on associate, which is A. Post acquisition profit. Then now it's for associate. So the post acquisition profit for associate already we did it, we calculated it here. So I just pick it to save on time. Yeah, so I just pick it here and copy it. Yeah, then now I'll adjust. I'll adjust with now the expenses. So I'll just come here and start with the impairment loss. Net loss. So the impairment loss, I come here and I'll start with the impairment loss for subsidiary. So I'll say impairment loss, then I say S. Yeah, so this I'll start with the negative because I want it to be negative. So I'll come here and check on the impairment loss under Goodwill. So it was 64. So I'll pick that 64 and I'll apportion it. I'll pick only the 80%. Sorry. Yeah, then enter. I'll have that. Then I'll also look at the impairment loss for associate. But now A, which is the associate. So impairment loss under associate, yeah, we already apportioned it. So we just pick, just put into negative. Yeah, just pick this, the whole value, which is 33. Yeah, then I'll go to depreciation of buildings on fair value uplift. So I'll go to depreciation. So I'll start with the dip, but now for S, for the subsidiary. Yeah, so I'll come here. Yeah, and you can see it is this, but sorry, let me say equals to. So I'll pick this depreciation and I'll multiply by 80% because the only portion that the parent has is 80%. So I'll put the negative sign so that it changes into negative. Then I enter. Yeah, so that was the depreciation. Yeah, that's 80%. So I'll go to depreciation now. Under the depreciation now for associates. So I'll just come here and say equals to, and I'll also apportion it. Where is associate? Yeah, this was the depreciation. So I'll pick it and apportion it. I'll only pick 30%. Yeah, because that's what the holding company controls. Yeah, so I'll go to the next item, which now is the the UPF. And you can see it's from holding, from parent to subsidiary. So that's downstream. So UPFA, we say that we deduct it from retained earnings and the PPE. So I'll deduct the UPFA completely. So I just come here and say UPFA. And I'll deduct it. So I just say equals to, then I pick the 25,000. It is, yeah, this one. So I'll pick it and deduct it. So I'll go back. The next one is the excess depreciation. Yeah, I'm not apportioning because it's the parent that sold to the subsidiary. So let's say excess depreciation. So my excess depreciation, I'll add it back. Yeah, you always add it back to retained earnings and PPE. So I'll add it back. So I just take it the way it is. So it is here. Yeah, so I want a portion because it was in full. It's the parent that sold. Yeah, so I'll go next. I'll follow. Yeah, then I'll go to UPI. Yeah, this the subsidiary that sold to the holding company, S to H. So I'll say UPI. So the UPI will be, yeah, I'll apportion it. So I'll pick this and multiply by 80%. Yeah, because it's a subsidiary that sold, it's an upstream. Yeah, and I'll create the negative sign. Yeah, so that we'll have that. Okay, so the next adjustment I will come to, yeah, H to A, there was a UPI. Yeah, so I'll also include it, say UPI, but this is under A. Let me say A. Yeah, and let me change this to S so that I don't confuse you. So go to under A, we'll pick it, but we will deduct it. We'll deduct it. So I'll deduct the negative sign. Then I just pick it the way it is because it was already apportioned. Yeah, so with that, I don't see any adjustment on retained earnings account. So I just sum this. Yeah, so I'll have 1457,920 as the retained earnings. So once I'm done with all this, now I'll go to consolidation. And now on our first solution, we say that the S was subsidiary while A was an associate. So I'll only consolidate H and S. So I'll start the consolidation. So I just come here and write H group. H group. Consolidated statement of financial position as at 31st December 2022. Yeah, so I'll create the bottom border. Just come here and create the bottom border. Then I'll just merge this and center. Now also come here. Merge and center. Yeah, and I think that would be okay. So yeah, that would be okay. So the values were in thousands. So I'll just copy this. Yeah, just copy that. So it's in thousands. So I'll start the consolidation. So I'll start with the non-current assets. Yeah, so those are the non-current assets. I'll start with property, plant, and equipment. So I'll start with property, plant, and equipment. So this is how I'm going to consolidate. So I'll start with, yeah, so I'll say equals to, then just equals, then I'll pick this. Yeah, I'm only consolidating for H and S, and add this. So I'll also add the fair value uplift. So the fair value uplift was 50 under S. Then I'll subtract the depreciation. Then I'll add back the excess depreciation. Then I'll subtract the UPFA because I have to eliminate it here also under PPA. The unrealized profit on fixed assets, and we'll enter. Yeah, so once I enter, yeah, so I've added the fair value uplift, subtracted depreciation, yeah, yeah, this depreciation for S, then I've also added the excess depreciation, then subtract the UPFA and this one. Yeah, so that's how you are supposed to consolidate property, plant, and equipment. So I'll go to the next item, which is the intangible assets. Yeah, so here I'll just have to add the two. There was no more adjustments. So I'll just add this plus this. And I enter. So I'll have 55. So the next item, there will be investments. Yeah, investment. I'll consolidate for H plus this. But remember, there was investment in subsidiary and associate. So I'll subtract them. Subtract this. And I'll also subtract this also. But there was also H Limited also invested in its 25 million of the loan stock in S Limited on 1st January. So this internal investment, I'll also reduce this by 25,000. And I enter. So once I enter, it will give me 60. So the other items here is the investment in associate. So I just write investment in A now, because the associate is known. So I just say investment in A, and I'll pick the value that we calculated here, which is this, and I enter. Then the next one is goodwill. There was also goodwill. Goodwill here will be equals to, we just pick it where it was. So goodwill here is 96,000. I just pick it. Yeah, and I think that's all under non-current assets. There's no any other item to be adjusted. So I just sum the total. Sum. I'll sum all this. Yeah. Yeah, then I'll go through the current assets. Then I'll start with inventory. So that's equals to, and I copy the inventory. So inventory, just come here and say equals to, I'll consolidate the two. So I'll pick this plus this. Then I'll subtract the UPI, this one. Subtract this UPI. Yeah, subtract that UPI. So get that value. Then I'll go to the next one. It is trade receivables. So the trade receivables, I'll consolidate this plus this. But there were intergroup balances. We are told was 25,000. So I'll subtract the 25,000. Then I'll also subtract the cash in transit, which is 5,000. Yeah, I'll also subtract this, this cash in transit. Yeah, from receivables. And then the next item will be cash at bank. Cash at bank. So I'll consolidate cash at bank, and I'll add back the cash in transit to cash at bank. So I'll pick this plus this. Then I'll add the cash in transit. Yeah, it is here. Okay, and then I'll have the total assets. So let me just copy this. Total assets. Yeah, so I'll just sum this on through. So I'll sum it from here. There. Say enter. So we'll have 43, 14. Yeah. So let me just bold this. Let me bold it. Let me bold it. So I'll bold that. And so I'll put the upper, the top border. Then I also put the double bottom border. Bottom double border. Yeah, to close that total assets. So I'll now go to equity and liabilities, and let me jump to that. So I'll start with the ordinary shares. So I'll just pick this. Yeah, and for ordinary shares, you only pick for the parent. You pick the one for the parent. So if we had ordinary shares and share premium, you only pick for the parent. So I'll pick that. Yeah, then I'll go to return profit. Just copy the returned profits. So I'll just come here and say equals to the return profit. I just copy, we calculated it here. So I just pick that value the way it is. Yeah, then I'll go to another one is NCI equity. NCI equity. So I'll also pick it, just equals to. Then I go where we calculated it. These are the values. I just pick it the way it is. Then the next thing is so I'll share the total total equity. So just say total capital. So sum this is equals to that. So we love that the total equity. Let me just bold it. So I'll go to the next item, which is now the non-current liabilities. Then we have the 10% loan stock. Yeah, so I'll consolidate it. So I'll consolidate it. So I'll pick this plus this. Yeah, but you recall that the 25 million was a loan stock from S Limited. So we'll have to subtract it. So I'll subtract the 25 million because those are internal debts. So I'll have to subtract it. Intergroup balances and debts. Then I enter. Yeah, right. So I'll go to the next item. The next item is current liabilities. So I'll just pick current liabilities. Then the next one is trade payable. Trade payable. Yeah, so the trade payable, I'll do the consolidation the same way. Do the consolidation the same way. So I'll pick this plus this, but I'll subtract the intergroup debts, which was 25,000. This one. Yeah. Then the next one is bank overdraft. So I'll have that and also consolidate. Yeah, there's no adjustment. So I'll just consolidate the bank overdraft the way they are. So I'll pick this plus this and I enter. And then the next item there is the current tax. Say equals to, I'll also consolidate it directly. There were no adjustment of tax. So I'll pick this plus this and I enter. Yeah, then the next one will be total liabilities. Total liabilities, then total equity and liabilities, total capital and liabilities. So the total liability, this is what I will do. I'll just sum this all through. So let's say equals to sum this. Then just once I enter, let's say equals to, now total capitals and liability, I'll just take the total capital and add to liability. Yeah, and it will give me 43,114,510.68. So it balances with the total assets. So it balances with the total assets. So let me just bold this. Yeah, I'll bold that. And I'll create the top border. Create the top border. Then I'll create the bottom border. Bottom double border. Yeah, so the consolidated financial statement balances at 43, at 431, yeah, at 4,314,510.68. 4,314,510.68. So this is how you are supposed to tackle this question on consolidation. By that you'll be having your free 20. It was 20 marks. Yeah, it was 20 marks. So you'll get your free 20 marks by doing this question the way you have done it. Yeah, so for those who are doing BDA, you have contacted me. My contact is attached on my channel, so you can contact me for classes, which run 3 days in a week. Yeah, so thank you for watching, and please subscribe to this channel so that we can reach 1,000 subscribers. Reach 1,000 subscribers. So have a blessed evening. Thank you.